Today knowledge sharing webinar organized by Mehta Mehta. Thanks a lot for your continuous participation. Today's topic is webinar on an insight into the REIT regulation. Friends, this is totally different of bit. In India, it is there, but not yet reached at a down level at retail very well. Not so well known. In compliance also, not many people are there. And we are lucky to have with us Mr. Vijay Kumar Gupta, General Counsel, Company Secretary and Compliance Officer of Nexus Select Trust, which are one of the REIT email. Welcome, Mr. Vijay. Thanks a lot for your time. And we are sure that people will get benefit of your knowledge. To formally introduce Mr. Vijay Kumar Gupta, Mr. Vijay Kumar Gupta is a seasoned legal professional with 25 plus years of experience, having worked at leadership positions in legal, secretarial, and compliance across real estate, commercial leasing, retail, hospitality, and IT industry. He presently associated with Nexus Select Trust in his capacity as General Counsel, Company Secretary, and Compliance Officer. The best combination which CS can do, you have taken all together. Wonderful.
Thank you, ma'am.
Prior to this, he has had a long stint with K. Raheja Corp Group, where he was involved with their retail, real estate, commercial leasing, and hospitality verticals. He was actively involved therein in the launch of 5 new malls, multiple acquisitions, and monetization of assets. He has also worked with CMS Computers Limited, wherein he was instrumental in the restructuring of the group and private equity. Welcome, Mr. Vijay. Today's our presenter is Ms. Kinjal Mehta. Kinjal is a chartered accountant and company secretary. She previously gained experience in EY assurance, auditing prominent private sector banks, and contributed to M&A transactions with EY strategy and transaction advisory team. She also worked with Blackstone Capital, a venture debt fund, underwriting investment in growth companies. Currently, she serves as a senior associate in Mehta Mehta's IPO team. Our moderator, Mr. Bala, need no introduction. So thanks for your participation. Thanks, panelists. Just to introduce our topic today, REIT. As people know, all Indian investor wants to invest in real estate, but the limitations are there, legal complications are there, protection to the fund and volume. And to that option is REIT, but I will not say much on that, because we have a panelist and presenter and moderator who will say the few words. With this, I will request Mr. Vijay to say a few words on the REIT. And just, Mr. Vijay, we want to know why REIT is not so known and what steps are taken or should be taken in your view. Over to Mr. Vijay.
Thank you, ma'am. So, thank you for this opportunity to address this August forum and be able to talk to the listeners. So, REIT or Real Estate Investment Trust, as you largely call them. So, in India, they were first introduced by way of a law in 2014. So, prior to that, there was no regulation. There was no way that REITs could have happened in India. So, after that, the first IPO, because once REITs first brought into India, they were looked at with the industry kind of, met the government officials, and they could be sorted out over a period of time. So effectively, only in 2019 that the first IPO of a REIT happened. And as of today, you have 5 REITs, which, if you see, are all done by either, the big, large institutional FIs or by large real estate houses in India, which are very well known. So it's slow adoption, but as you see, it's taking pace. And with the success of these 5 IPOs, and then the way SEBI has taken up the stewardship role of ensuring that this is a institutionalized mechanism which is well adopted. We should very well see success. So, though India, we see that this is only in 2019 that the first IPO happened. But worldwide, if you see, it's not a new product. It's been there since 1961 in US when the first REIT IPO happened. And after that, slowly, if you see, it's adopted by more than 40 countries. It's a way of investing in real estate in the developed economies. So if you look at US, at least 95% plus of the real estate market capitalization now is through REITs. Or similarly in Australia, which is around 94%. Japan, if it's like around 70 to 80%. And Europe, another 60 to 70%. Singapore, somewhat same percentage. So if you see, developed economies have already have taken it up, and this has been established as a preferred institutionalized way of investing in real estate. But India's probably slow, and probably it will take shape over a period. So just to talk about REITs a bit, see, these are basically you would say pooling of investments by people, investors who come together collectively to own real estate and manage. So the difference here is, instead of you having, say, a single person who is expected to invest heavily in real estate and thereafter set up the commercial offices or shopping malls, or as the case may be, and then over a period earn out of the same. So here, if you see the difference when you look at from a individual versus probably a corporate. So in case of an individual, for him, he has been always seeing real estate as a lucrative investment, and at least for the last 10 odd years or 20 years, it has become one of our diversification instruments for investing in other alternate routes, whether you look at, say, gold, possibly securities, mutual funds, and this is an additional route which is available for investment for individuals. But at the same time, when you're looking at investment, you realize, the construction cost, the title related issues, or other larger issues, which kind of bog you down. Because see, even if you say, considering all these things, you set up or you buy something, you would look at probably owning a few shops. So there's no diversification. So you have invested in probably a small space, and you're looking to earn yields out of the same by way of rental. So compared to residential, if you see the returns, which are roughly like 2 to 3% in Bombay and other larger cities, probably in other larger cities, other smaller cities, it may be 3 to 4%, but still it's like very low. Commercial real estate, it's still large, around 4 to 5%. But then again, your risk which you take, one, you're investing in a very small space, which is part of probably a larger commercial space. Now, though these commercial spaces which are set up, they have a lot of promise made from promoters with respect to management. But if you look at today, the number of malls which are there and which are owned by multiple, say, 50, 100 owners, you see the quality of management. In fact, I would be surprised to find even 1 or 2 successful stories around the same. Now, as compared to this, you have an option wherein you can have an investment in REIT, which is a SEBI recognized instrument. SEBI has set up, guardrails to ensure that, one, it is sponsors who are in, having a good history with respect to setup of, or who have a history with respect to developing real estate. A manager is appointed to manage the assets, who has again experience in managing and, keeping real estates up to the mark, ensuring the returns are collected. There's an active role with respect to tenant management, and thereafter distributing the returns to the investors. So compared to, when you personally invest in, say, real estate versus a REIT, which is a structured way of investing. See, in simple words, it's nothing but like kind of a mutual fund for real estate.
Right.
Investors are coming together. So you have a sponsor basically a person who brings in real estate, uh, puts this real estate, rent yielding real estate in a trust, appoints a trustee who is basically to hold the real estate for the benefit of all the investors, appoints a manager who manages the real estate and then distributes. So, the benefit that you see is there is an institution, there is a professional management, there is a diversity of risk. So, REIT possibly has offices or commercial space spread across the city or possibly across multiple cities. So, possibly if there is say a downturn in a particular city, you are not really, in a precarious scenario where you find that you are heavily invested in that particular city, and there is no way that when you want liquidity, you find, you get promises by way of ensuring that, when you exit, you can exit at the earliest and very easily. But when you look at really exiting from real estate, it's not so easy. You find that the prices are being quoted very low, or the extent of liquidity you were promised, it's virtually absent. As compared to that, you have a REIT, which is listed on an exchange, which which is high liquidity, of course. And if you find that SEBI has been taking active steps to ensure that the liquidity is increased, recent measures including, recognizing strategic investors as all QIBs, or permitting, large capital houses or family houses to invest, provident fund to invest. So now, as compared to earlier, when REITs were, so the ticket size of investing that used to be something like 2 lakhs or 3 lakhs for the minimum investment in REIT. Now it's made on the same lines as possibly equity. So at a time of IPO, you had a recent IPO of Knowledge Real Estate Investment Trust. The ticket size is just 14,000 or 15,000. So, and in the secondary market, you can just buy one unit, which is generally say 100 rupees, 200, 300. And the assurance or the returns that you're getting are at least 9 to 10% of your unit cost. And then additionally, what you get out of this is there is a capital appreciation which also gets recognized in the unit price. So you see, if you see Knowledge Reality, which had an IPO, which would ensure that around 8 to 9% is distributed every year, and the appreciation in price itself is from 100 rupees of a unit price, it's like 115. And then the second measure which SEBI has done is that these instruments have now been recognized as equity for purpose of mutual funds. So this, if you see, is going to encourage mutual funds to invest heavily. So over a period, whatever liquidity gaps that you saw, they could be kind of covered when the moment, mutual funds, they have this as a recognized way. So see, if you look at the investment in REITs, it was largely being done by institutions, be it mutual funds, FIs, insurance companies. Now this scope has increased. Now you have provident fund investments or insurance companies which are permitted to invest. And on top of it, this mutual funds, wherein earlier this was recognized as a hybrid investment equivalent to debt somewhere, but today it's recognized as equity. So probably the returns which you're seeing in some time, they may be equivalent to real estate investment, the real estate companies, the way they are seen by the market for purpose of capitalization and yields. So it's a long fetch, but possibly it's very soon that it happens. So to tell you, it's over a period that growth has happened. It's not that it will happen overnight, but slowly it has grown and probably taking place.
Okay.
Over to you.
Thanks, Mr. Vijay. Thanks for your inputs. Kinjal, you start sharing the screen. Mr. Bala, just 1 or 2 lines because we have to finish in by 1 o'clock. Kinjal, you start sharing. And say the full of the presentation.
Good morning to all of you. I have a great pleasure in welcoming you all on behalf of Mehta Mehta and also on my own behalf. We heard, from our panelist Vijay Kumar, he nicely explained everything. I will only add two things. One is I'm looking from the investment point of view. Second thing, I'm looking from the professional company secretary's point of view. From the individual investor point of view, as he rightly said, it is very difficult for an individual to invest in the real estate because due to the high cost, etc., and other thing and all. This REIT actually, what is doing is they are making the investment in the large scale, like he said, shopping malls and offices, etc., and other thing and that, which is actually producing what you call the rental income. That is what it is happening, which is ultimately distributed to the retail investors. As he nicely given a comparison like a mutual fund, here also again you can buy in terms of the units in the real estate without you being a direct ownership in the property. And again, it has got its own advantages of, liquidity, diversification, trading in the stock exchanges, and also the stable income by way of the dividend, which is actually happening. He already pointed out what is the income rate which is actually happening. That is one thing. So really speaking, this particular REIT is really a sort of a bridge which is actually serving between the public financial institution at the one hand and the demand of the property on the other hand, giving the opportunity to the investors. That is one thing.
Right.
So, yeah.
And I think, Mr. Bala, can we start this?
We can do that. Only one thing I would like to only touch upon for our employee professional and as well as the company professional, we have a lot of things to get into this. This is being a new area because the applicability of some of the LODR regulations, board composition, compliances, other matters which are actually called for, which is very new area. Since we have an opportunity to learn these things and if people could take this another area of the practice alternatively, that is what I would like to say.
Rightly mentioned. That's why we are taking this webinar and presentation.
Yeah.
Right. Kinjan, you can start sharing. And friends, please put your questions in the chat box. It will be taken during the presentation and people will be allowed to speak at the end of the session if time permits. That's why, sorry, I'm pushing the panelists for the presentation. And also this presentation will be in YouTube, our YouTube channel, Decoding Corporate Law with Mehta and Mehta. You can subscribe that channel. All our earlier webinars are on that channel. Yeah, can just start sharing, please.
So good morning, everyone. Today's topic, as already mentioned, it's on real estate investment trusts in India. So to give a bit of a background, India, the way it's growing, and the way you have foreign institutions and multinational companies entering into the country. There was a large need for upgradation of the real estate and infrastructure that was available to accommodate such growth and to keep up with such growth. And that required a lot of funds going into an area like this. The introduction of REITs allowed institutionalization of this particular sector to kind of foster a growth in real estate and infrastructure in the country to keep up with the growth that India is already experiencing today. So REIT allows democratization of real estate investing, which essentially means that before, if you wanted to invest in a particular asset, it would require one investor to go in with a large chunk of capital, which you only had only certain percentage of the public that could invest in an asset like that. But today with REITs, this instrument essentially allows small and large investors to invest in high quality income generating real estate without directly owning the physical property. Because there are a lot of issues that also come with owning a real estate, being liquidity or taxes and XYZ maintenance, XYZ other things. So REITs is essentially a mutual fund for real estate, which means that REITs pools money from investors in the form of units that are listed on stock exchanges to invest in income generating real estate. It distributes the rental income earned to its investors and it is professionally managed by a REIT manager. So this whole, where real estate is considered as an industry which is not very professionally managed and all, this instrument allows for institutionalization and professionalization of this entire industry. Now, this was a long road coming for SEBI. SEBI introduced REITs in 2014 with its framework, legal framework. But there was, ambiguity when it came to taxation in terms of who was going to be taxed, the rental income, the investors, the interest, the dividends. All of that was kind of ironed out between 2016 to 2018. And by 2019, India saw its first REITs being listed by the Embassy Office Parks. Now we are looking at a typical structure of REIT and how it operates. REIT, you have the unit holders, which can be retail or institutional, that essentially own units. Now units are ownership rights of the 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 assets that are indirectly the assets that are owned by the REIT. The REIT has a trustee and a manager. Trustee that looks into the trustee tries to ensure that the interest of the unit holders are protected, whereas manager professionally manages the properties that are there. Now, this management is done through a holding company more often than not that holds special SPVs, special purpose vehicles, that in turn hold the actual real estate assets. This I will be kind of getting into deeper going forward. So the investors come in with their capital in terms of the units that they own, that they invest, that is listed on NSE, BSE. And the REIT trust that is managed by a REIT manager invests this capital into a holding company, which then goes and invests into SPVs. And the SPVs actually look into owning these assets. These are usually commercial projects in the form of offices, malls that provide rental income. Now, this rental income is collected by the SPVs, and the SPVs pass it on to the holding company, that in turn pass it on to the trusts, and which goes back to investors in the form of dividends. Now, in India, to set up a REIT, it is set up in the form of a trust under the Indian Trust Act, with a trust deed that identifies sponsor, trustee, manager, that must be separate entities. And the trust deed must be registered, compliant with SEBI regulations, and must be signed by sponsor, trustee, and manager. To constitute a REIT, it must be set up. It must be the application form is the application is done under Form A under Schedule 1 of SEBI REITs regulation, with an application fee of 1 lakh to the divisions of funds in SEBI, with certain documents, accompanying documents that are listed in on your screen. Then the SEBI goes through these documents. If it has any clarifications, then it comes back to the REIT to clarify certain things, and then it provides the registration with a registration fee of some 25 lakhs. Once this is done, then the REIT sets up its structure in the form of a holding company that holds, it has to hold more than 50% interest in the SPVs that then go again and hold properties. SPVs should ensure that more than 80% of their assets are usually in completed and rent generating real estate form. And once after the registration of SEBI, this entire structure is essentially set up. Once that is done, the REIT appoints the principal valuer for periodic valuation of properties that is required under the regulations, an auditor, register and transfer agents, and merchant lead banker for listing of its units. Now we'll get into roles of all of these different participants that are there in the entire structure of a REIT. Look, getting into the investor or the unit holder, they actually provide capital that enables the REIT to acquire, develop, and manage large-scale income-generating real estates. It also is a beneficiary of the income that's generated from this real estate. SEBI mandates that at least 90% of the net distributable cash flow, which is collected from the real estate properties that is managed by the REIT, must flow to the investors. They are also market participants that provide liquidity, which traditional real estate investments, usually lack. They are also indirect owners of real estate. They effectively own a fractional share in the portfolio of assets held by the REIT. The value of their units reflect the underlying property value and its income generating capacity. They also are the ones who actually bear the risk. Now, this could be, market related risk, interest related risk, and any other operational risk. Now, the essence of REIT is that no unit holder of the REIT enjoys superior voting rights or better rights over any other unit holders. All classes of REITs are essentially same. The exception is that the subordinate units can be owned by sponsors. Now, this is kind of put in place to allow minimum holding requirements under regulation for sponsors. And they can only carry inferior rights. They cannot carry any better rights than other retail or institutional unit holders. Now, these unit holders collectively holding not less than 10% of the total outstanding units shall be entitled to nominate one director on the board of directors of the manager, which kind of gives them the right to ensure, how the fund is managed.
So if you, just a second, Kinjal. So if you look at the role of the person who is holding more than 10%, so people can collectively come together and appoint a director on the board. And there is a stewardship role which is prescribed under the Act also, under the regulation, which expects any such person who is appointed on the board to kind of take care of the interest of all the unit holders put together. So this is a novel mechanism which has been put in by SEBI to ensure that there is a participation by the nominee, by basically the unit holders as well, apart from the sponsors. Please go ahead.
It is more or less something like the small shareholder director appointed in a listed companies where they have about 1,000 and above or 1/10 of the small investors. That is what it is, to ensure that is one. Second thing is, somebody is asking, is investing in the REIT, is investing in the mutual funds or investing in the share? That's what he is asking. I think you rightly said in the beginning itself, the REIT is actually nothing but it is the units, which is the alternate investment like that of the mutual fund. There is no share, it is actually the units. Again, units are traded in the market. That's what I believe.
So it can be compared to fractional ownership, as Kinjal pointed out, which is the ideal way to define it, because unlike a mutual fund where the mutual fund units are so spread across, so effectively you don't get any right with respect to the securities or the companies involved. In this case, the underlying assets, which are basically real estate, which is a rent yielding asset, you get a fractional ownership in respect of the same. So comparatively, it's much better than a mutual fund and has its own benefits.
Somebody is asking, putting up a question, what is the difference between the ordinate and normal units?
So these were subordinate units. So I think so. He did.
Yeah, subordinate.
Word. It's subordinate.
Subordinate units and normal units
are basically a unit which is inferior as compared to a normal unit. So if you see the units which are listed, which are issued to uh, investors, basically the unit holders, they are all equal in all aspects. But SEBI, in order to permit sponsors to kind of bring in, so the only class which can be issued subordinate units are only the sponsors. Nobody else can be issued these units, which, as pointed out, they are subordinate as compared to the units which are issued to the investors at large.
Someone was putting up a question, what is the income tax application of the dividend income on the capital gain on the units of the REIT?
So see, capital gain for short term and long term is same as compared to all other securities. So you have a long term and a short term, which depends on your period of holding. Now, dividend is something a bit different. So what dividend? So if you look at distribution from unit holders, it can be to unit holders by a trust. It can be by way of multiple means. One is dividend, of course. So the dividend in respect of paid by SPVs, which are under the old regime. So there's a 115B AA, which is the new regime of taxation. So if SPVs are under the old regime, it's tax-free in the hands of individuals because it's taxed by in the name of the in SPV's hands, right? I hope that answers it.
Yeah, I think.
Yeah, thank you. Yeah, go ahead, Kanya.
So why? So this REIT as an instrument is relatively unique when it comes to other instruments in the market. So why would an investor look to invest in an instrument like this? It has its pros and cons. So the return that the investor gets, it's highly dependent on the rental income which is collected from the assets that are owned by the REIT. And so this REIT must distribute 90% of their net distributable cash flow, which they've collected from their assets, to its unit holders, which kind of results in predictable, steady income for any investor. It is also a low ticket access to grade A real estate. You can invest with as little as 10,000 to 20,000 rupees in and own a fractional part of real estate, which otherwise would be much more if you wanted to own a physical property, which would require probably lakhs crores, which makes institutional grade real estate very accessible to retail investors. Now, unlike physical real estate, listed REIT units are traded on stock exchanges, which allows easy buy and sell, giving investors the real estate exposure without locking money for years and providing liquidity to investors who want to invest in this instrument. Um, Now, REIT is also professionally managed. Assets are managed by experienced managers who handle the leasing, tenant mix, maintenance, finance, which kind of removes operational burden from investors. It also provides diversification and transparency in a portfolio for any investor. Exposure to large scale commercial real estate, such as offices, malls, hotels, warehouses, that individuals cannot easily buy for themselves. It kind of reduces the risks by diversifying across several assets, tenants, and geographies, which otherwise you would be paying crores and putting into only one property otherwise. It also protects it against inflation, given the typical steady income and growth that it provides. Rental escalations are usually 5 to 10% every 3 years, which kind of protects against inflation. And property values also often rise over a period of time because of economic growth. But this instrument also lags in a few ways. It provides it comes with market linked volatility. Since they're listed and you have retail participation, and so they behave more like stocks and can be volatile due to, say, many reasons such as interest rate movements, market sentiment, economic slowdowns, etc. They are also sensitive to interest rate changes, REIT prices often fall when interest rate rises because debt becomes more expensive. Investors prefer bonds over, yield-based products like this. Then there is moderate capital appreciation. REITs are primarily income focused, so price appreciation tends to be moderate, not as much as an equity stock. So it probably is not suitable for someone looking for high capital gains over a period of time. It also is very dependent on commercial real estate cycles. Vacancies, renegotiations, or oversupply in commercial market can reduce the earnings distributions, property valuations, which affects the returns for the investors. They could face tax complexities for at least for retail investors, because dividend is taxable depending on SPV debt status. Interest is taxable at slab, and the amortization is not taxable but reduces cost base. And so there are a few more things to be taken into account when computing tax, which may get a little complex for, say, someone, a retail investor. Then you have a manager-related performance risks. So you have professional managers who are managing these assets. Any poor decisions by the manager regarding acquisitions, tenant selection, capital structure, etc., can affect the returns that are owned by the investor. Now, moving on to the role of a sponsor, who's another participant in the REIT structure. Now, the sponsor is essentially the promoter and creator of the REIT. It is the entity or group that establishes the REIT and initiates the registration with SEBI. Much like a promoter in a listed company, the sponsor's role is to conceive, structure, and launch the REIT. Sponsors are typically large real estate developers, infrastructure firms, or financial institutions with significant experience and strong asset base. They are also a provider of initial assets. So the sponsor contributes or transfers income generating real estate assets to the REIT, usually through SPVs initially. These assets form the initial portfolio that generates the real estate income for the REIT. By transferring these stabilized, high quality properties, the sponsor enables the REIT to begin operations with predictable cash flows. It is also the capital contributor. SEBI requires sponsors to hold a minimum continuing interest in the REIT at 15% of the total outstanding units for a period of 3 years after listing, ensuring that the sponsor remains invested and aligned with unit holders' interests and promotes confidence and accountability in the REIT. Sponsors also strategic advisor and brand anchor. The sponsor's reputation, credibility, and asset quality are essentially key factors influencing investor trust in the REIT. If you have embassy, you have all of these other bigger developers that provide kind of brand recognition for and trust for people who want to invest in a REIT. They also provide compliance and disclosure when setting up the REIT and while listing of the REIT. So during the setup and offer stages, the sponsor must provide detailed disclosures about the assets, valuations, and financial performance to SEBI and the public. They must also demonstrate a track record of profitability and experience in real estate or fund management to qualify under SEBI REIT regulation. Now, as per the regulations, each sponsor shall hold or propose to hold not less than 5% of the number of units of the REIT on a post initial offer basis. So the minimum holding must be 5% at all times. The net worth, collectively, the sponsor must have a net worth of not less than 100 crores. And individually, each sponsor must have a net worth of not less than 20 crores. Experience-wise, also, the sponsor or its associates must have not less than 5 years of experience in development of real estate or fund management in the real estate industry. If the sponsor is a developer, then at least they must have at least completed 2 projects in their career.
So just a point here. So if you look at from the side of a sponsor as well, they basically invest in real estate, and that money which is getting returned by way of by way of annuity in respect of by way rental is something which is slow, and then the sponsor is stuck in that asset. So this also, apart from being an instrument which is beneficial for the public at large, is also for the benefit of the sponsors, because they get a part exit which they can thereafter invest and create further assets. So in a sense, it's helping the economy at large, wherein capital is getting free and can be utilized for further real estate development.
So
And
this is
Either the maximum holding is prescribed in the law, because minimum you talked about 5%.
so maximum is like they say 75%. You have to ensure that at least 25% of the REIT units are available to the public. Same as listed companies. So in case you're not meeting that norm, you have to meet that norm within 3 years.
So that means it varies from 5% to 75%.
No, in fact, it's like as low as 1%. So after 15 years, the requirement of the sponsor to hold goes down to 1%.
Okay.
So starting, it's like 15%, but it's a gradual step down.
So they get monetization, they can monetize their investments.
Exactly. That's it.
So it's a two-way benefit. Actually, I wanted to ask that only because it is beneficial to real estate developer also, because that will help them give the liquidity, which is a major issue as regards real estate. So it helps for both, and that's why it will promote. Yeah.
So this annuity assets, if you see, the success depends on the sponsor being able to create some kind of exit, which is being provided by way of REITs.
Moving on to the role of a trustee. So the trustee is the legal owner of all REIT assets, holding them in trust on behalf of unit holders, who are the beneficial owners of these assets. The trustee cannot be related to the sponsor or manager, and it must maintain its independence and objectivity because they essentially work for the unit holders. They are protector of investor interests. They ensure that all actions of REIT manager and sponsor are conducted transparently, fairly, and in compliance with SEBI regulations. If the manager or sponsor act, on the contrary to the regulations of the trust deed, then the trustee will take corrective steps, and including reporting the matter to SEBI. They also have a compliance and governance role. They ensure that the REIT complies with SEBI regulations, trust deed, applicable laws, including taxation, accounting, listing requirements. It also reviews and approves disclosures that are made to SEBI to ensure that everything is going correctly. They are also strategic advisor that overlook the operations of the REIT that go on. They also appoint they must be appointed by SEBI registered debenture trustee, and they must be a SEBI registered debenture trustee and independent of with independence. And the trustee's remuneration is fixed and disclosed to ensure that there is no conflict of interest. They should always ensure that there is no conflict of interest when it comes to their duties as a trustee. Now, the trustee must be registered with the SEBI under debenture trustee regulations. It must maintain its independence and not be associated with sponsor or manager. They also must have necessary infrastructure, personnel, to the satisfaction to ensure that they are able to govern and protect the interest of investors when it comes to the REIT. They must have the required resources, infrastructure, and personnel. They must also be a fit and proper person. They also, again, they must be SEBI registered debenture trustee that are independent. Moving on to the role of a manager. So the manager looks into the operations and portfolio management. They look into property management, lease management, tenant relations, and ensure that continuous rental income and are flowing in, and occupancy levels remain high. It identifies, evaluates, and executes acquisition and disposal of properties in line with REITs investment objectives. It ensures that the REIT invests at least 80% of its value in completed income generating assets as required by SEBI, and not more than 20% of its value in under construction and development projects. It ensures that there's timely valuation that's happening of the assets, and it prepares the disclosures as per requirements to SEBI, to unit holders, and to the stock exchange. And it also ensures that there's distribution of at least 90% of the net distributable cash flow that's moving to the REIT and the unit holders. It also undertakes governance and compliance roles in the REIT structure. It maintains internal control systems and risk management frameworks. It submits regular reports to the trustee and SEBI on operations and the transactions and financial condition of the REIT. It's a strategic. It plays a strategic and business development role also. It formulates and executes REITs growth strategy, including acquiring new assets, undertaking asset enhancements, renovations, releasing, to ensure that they are improving yields, and seeing growth in their revenue collections, rental collections. If they're looking into going into debt financing, any equity issuances for expansion, it aims to essentially enhance the net asset value of the REIT on a long-term basis with long-term returns for its unit holders. They also are the ones who communicate with the stakeholders. They act as the face of the REIT and engage with investors, analysts, tenants, regulators, and exchanges. Their remuneration is kind of divided into two: base management fees and performance fees. Now, these base management fees are linked to the REIT's asset value and income, whereas performance fees are linked to REIT's total return or distribution growth over a period of time. So, as per SEBI, the manager must have a net worth. If it's a body corporate or a company, then not less than 10 crores. If it's an LLP, then its net tangible asset must not be less than 10 crores. They must also have an experience of not less than 5 years in fund management or advisory services or property management in the real estate industry or in development of real estate. The manager must have not less than 2 key personnel who each possess not less than 5 years of work experience in fund management, advisory services, property management, real estate industry, real estate development. Not less than half of its directors or members of the governing body must be independent. They can't be directors or members or governing body of the REITs manager. So there must be independence.
There are some questions.
The manager must.
There are some questions that have come actually. Is there a difference between the dividend in the mutual funds, which is actually as an option of without dividend, etc., vice versa in the units of REIT?
No. So in REITs, there is a compulsory distribution. You can't have that option of, distribution. In certain mutual funds, you're right. They don't distribute. The appreciation is by way of, say, either bonus units or by way of appreciation in the value of the units. But in case of REITs, it's a compulsion because the intent here is to ensure that there's steady income.
There is another question continuing with the earlier question on the income tax. The same gentleman is asking. Thanks for answering question earlier. My doubt on the capital gain is for STT paid on the units under 112 or like any other capital gain. I doubt whether SET is applicable.
See, I don't deal in stock market, so I'll not be exact. But to my understanding, any unit that you buy and sell over the exchange, whether it's equity or REIT units, STT is applicable across. So I am not sure if there's any doubt on that. So, but I may not be the expertise to answer this basically.
No, if it is traded in the market, yes, it is applicable, as you rightly say, that is across for all, irrespective of anything. That is absolutely correct, actually.
Yeah.
Will I get the presentation at the end of the webinar? I think Dipti has already answered that our disseminated recording webinar will be taking place on our YouTube. You can actually subscribe, you can actually watch it, which contain the PPT. PPT as such, we are not distributing here. So money invested in the REITs should have developed assets or funds invested to be used for the future development.
Sorry, I didn't get the question here.
Money invested in the REIT should have developed assets or funds invested can be utilized for the future developments.
See, as I said, the limitation is that any returns or cash flow has to be distributed to the extent of minimum of 90%. So 10% can be retained. And in fact, if you see majority of the REITs which are in India, they're distributing the full 100%. But yeah, you're right. To the extent that this 10% is there, you can retain it for purpose of acquiring further development.
Somebody is actually seeking your suggestion. Suggest the good REIT option to invest, and do we need a separate Demat account for it?
So Demat is a must. So I am actually a bit conflicted, so I may not be able to answer that question.
You have to take a call. You have to study in the market. You have to take a call. And it is your judgment.
I would like to give that much comfort that all these REITs which are there currently, they are developed, or the sponsors are very reputed developers or institutions. So you can at least be convinced on the wherewithals of the institutions involved. And you will see from the holdings of theirs currently that there are lots of mutual funds and foreign institutions which are investing heavily in the same. So I can say definitely that all of them are very good, but I'll not be able to answer which one is the better one.
Yeah, that is one's own judgment. They'll have to study, they'll have to take their own judgment. That's what they'll have to do it. That's right. Can NPSC act as a sponsor? What is the employer 500 crores?
Sorry, come again. I didn't understand.
Can a non-banking financial company act as a sponsor?
NBFC as a sponsor.
Yeah.
So it says NBFC as a developer. Sorry, a sponsor as such. I don't think so. They prescribe that it has to be a NBFC, but I think so. NBFC would have its own restrictions to get into real estate, etc. I think so. There's a restriction vis-a-vis that. So you can look into it more from the NBFC angle. From the REIT angle, I don't think so. The REIT Act says that it should be an NBFC or not be an NBFC.
NBFC, again, you have to go by the RBI regulation, the Marshall Circular, that you have to consider. That is one thing. Because there is also a rider who has to have the net worth of 500 crore. That probably you have to go by the RBI regulation, I think so. Could you elaborate on the governance mechanism to prevent the conflict of the interest, particularly situation attracting assets or diverted sponsor group or affiliate entities instead of being offered to the listed RET? How does the REIT ensure the access of the pipeline assets and maintain transparency in related party transaction? Example, the emphasis group of many system concerns.
Basically, related party transaction impact on.
I think she is going to discuss the related party transaction that is coming there. So you just to go through it. Once you get the presentation made, then you can see whether your question will get answered.
Otherwise, we take as at that time, panelists can attend this question because it is the presentation.
True.
Can REIT own a manager concerned assets out of...
Mr. Bala, there is a mistake. Can REIT own and manage commercial assets outside India? Out of India, sorry.
No, so as of now, that's not permitted. The asset in India.
Yeah, Bajaj Wealth Management Limited versus the Chief CIT judgment of Supreme Court is the definitive authority that established the principle that for the purpose of capital gain taxation, an investment in REIT units is legally and functionally equivalent to an investment in company shares. Okay, thanks for your input.
It is only for the information, I think so.
Hmm.
Okay. I am from the real estate background.
No,
Would it be
leave it.
with you on the?
Which
Okay.
are REITs available, listed and unlisted, top 3.
So they effectively 5 only. So you know what to say, top 3.
Top 3 and all that. There are very few.
Yeah.
Correct.
What are
That's
the upcoming REIT listing in India? What do you mean by upcoming REIT listing? Means any
that anybody is planning to bring out the IPO.
So
That is
I
that is
don't
what it is.
have any understanding of subsequent or any REITs coming now after the last issue of knowledge reality. So
Okay.
we'll have to wait.
Okay, fine. Thanks.
But
Yeah,
one thing
yes,
is there
go ahead.
very, as you really said, this is being a new subject. There are only few players in the market. And really speaking, the latest amendment, which has actually come from this SEBI, I think the 25 only the second amendment has come about 3 months back. Probably we'll have to watch and see because permitting the strategic investor, etc., another thing and all. Probably depending upon that, future development will take. We'll have to watch and see. Yeah.
Yeah, Kinga, go ahead.
Coming back to the role of the manager, the requirements for a manager. The manager must enter into an investment management agreement with the trustee that essentially details the role of the manager's responsibilities as per requirement of SEBI. Moving on to the role of a holding company in the REIT structure. So, a holding company acts as an intermediate entity through which REIT holds the underlying real estate assets. The REITs may own assets directly or indirectly through a holdco, which in turn holds an SPV or a holdco that may consolidate several SPVs under one entity. Now, this structure gives flexibility in managing multiple projects, especially when assets come through acquisitions, mergers, and restructuring of legacy corporate structure or legacy assets. It also aggregates SPVs and the properties. Many developers already hold properties through different subsidiaries. The holdco essentially consolidates these SPVs under single umbrella, simplifies transaction structuring, enables REIT to hold assets indirectly while retaining equity control in the structure, and also reduces complexity in ownership and corporate governance essentially. It also ensures compliance with REIT ownership rules. So SEBI mandates that SEBI mandates specific ownership thresholds. So a REIT must hold more than 50% of equity in a holding company, and a holding company must hold more than 50% equity in underlying SPVs. This ensures control and transparency over cash flows that are collected from the underlying assets of the REIT. Also facilitates cash flow distribution up to the REIT. So a holding company plays an important role in upstreaming cash flows from SPVs to the REIT. SPVs own the real estate assets and generate rental income. They distribute at least 90% of the net distributable cash flow or NDCCS to the holding company, and then the holding company distributes 90% of its NDCFs to the REITs. Okay, so now the 90% of the rental cash flows that it has received from SPVs, it must carry this forward to the REIT by 100%. If the holding company is earning additional income by itself, then it can uh, 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 provide and distribute that income to a minimum of 90%, like at least 90% of this additional income, if the holding company is generating by any chance, then it must distribute to the REIT and unit holders. And all the income received from the SPVs, 90%, 100% of that must be distributed to the REIT and unit holders by the holding company. It also enables debt structuring in the REIT. So holding company can carry out debt obligations to enable, say, asset acquisition, refinancing of SPV level loans. It provides ring fencing of risks, which is essentially that the debt stays in the holding company rather than at the REIT level. So the debt is kind of specified asset wise or SPV wise rather than REIT as an entity. It also combines leverage limits across REIT, holding company, SPVs, and credit rating and all becomes simpler when you have a holding company taking on debt at SPV level. Uh, it also supports governance. It provides risk isolation and asset acquisition. So, a holding company must comply with REIT governance standards, related party rules, SEBI disclosure norms, audit and compliance requirements, valuation and reporting obligation. The REIT manager oversees compliance across holding companies and SPVs. The holding company also acts as a buffer to isolate risks. SPV liabilities stay confined within the SPVs. Holding company prevents direct exposure of the REIT to operational or legal risks arising from individual assets. It also so it's providing REIT risk containment when you have a holding company layer in the entire REIT structure.
There is a question is asked actually, how important and mandatory regulatory wise is the solar unit to REIT?
So there's no mandate under law to have a solar unit. It's more of because you have benefits by way of lower cost of power. That's why REITs would do solar power or any other kind of power, be it alternate power, to ensure that their billing in respect of electricity is reduced.
There is another question. If REIT has to hold minimum 50% shareholdings, does it mean that only 50% of the profit of the distribution of the REIT to the unit holder and the balance 50% profits goes to the other shareholders?
See, so you are either way investing in a ready asset. So when you buy a ready asset, you have invested with a very clear intent that you are buying 50%. So obviously your return will only be 50%. But at the same time, by virtue of the REIT regulations, the company, which is the SPV, is forced to pay at least 90% of the returns that it gets. So effectively, you are assured, say 45% of whatever is 100% is distributed by way of returns or cash flow.
Major real estate cities in India.
I think
major
real estate. Next it is holding company necessary? Can the REIT directly hold the SPVs?
Yeah, both are permitted. You can hold.
It was mentioned May, and the advantage of holding company was explained.
That's it.
Can the discussion
be supposed to be a case study?
This compliance itself is such a big. We have synchronized many things. So wherever required practical aspect or panelist telling, it becomes difficult. Yeah. First, we have to explain the people the compliance and regulation. Thank you.
Yeah, of course, the panelist is actually being from the REIT industry. He is sharing his personal experiences. I think that would greatly help to us. Yeah.
Yeah.
Go ahead.
As required, panelist will give the example. Okay. Yeah, Kelly.
Moving on to the role of a special purpose vehicle in this entire structure. The SPV legally owns the income generating real estate properties. It simplifies ownership. Ownership. The REIT holds shares in SPVs instead of directly owning multiple properties. It reduces legal and tax complexity after providing, operational flexibility. Having a special purpose vehicle owning such assets instead of REIT directly owning the underlying assets. It collects rental and other charges from tenants after paying expenses and taxes. The SPV contributes at least 90% of its net distributable cash flows to the REIT, which is mandatory under law. It also, each SPV is ring fenced, meaning any legal or financial risk related to particular property stays confined in that entity, and it does not go, the risk is not affecting at the REIT level. SEBI requirements for SPVs: a REIT must hold at least 50% of equity share capital or interest in each SPV. Each SPV must invest at least 80% or more of its assets in completed and revenue generating properties, as mentioned earlier. SPVs cannot undertake activities other than owning and operating real estate assets. So they must be very confined and focused on the underlying assets that they own. All REITs that are issued, REITs units that are issued, must be listed. So we'll just go through the initial offer requirements quickly. So a REIT shall make an initial offer to its units by way of public issue only. The value of REIT assets needs to be more than 500 crore rupees when you're going for such an issue. The offer size must be at least 250 crore and more. The minimum number of unit holders other than sponsors and its related parties and associates should be not less than 200. So there has to be multiple unit holders and can't be very concentrated. The maximum subscription from any single investor, and this does not include sponsor and its related parties, shall not be more than 25% of total unit capital. There is a public float requirement also when it comes to a REIT. Post-issue capital, if the post-issue capital is less than 1,600 crores, then it should be, public float should at least be 25%. If it's between 1,600 to 4,000 crore, then the value of at least 400 crores should be public float. And if this is more than, if the post-issue capital is more than 4,000 crore, then at least 10% should be public float requirement. In case this falls below the public float falls below the required amount, then the REIT is required to increase it in the prescribed period of time. So SEBI recently kind of introduced this concept of strategic investor when it comes to issue of offer. So a strategic investor is essentially a qualified institutional participant permitted to subscribe to units of a REIT during the initial offer. It was essentially introduced to enhance the credibility of anchor and anchor demand and support price discovery during listing. To be a strategic investor, it must be an infrastructure real estate fund, mutual fund or insurance company, foreign portfolio investors that meet the SEBI criteria, scheduled commercial banks, NBFCs, multilateral financial institutions, and systematically important entities as per SEBI. To be a strategic investor, they can invest either on their own or together with their group entities. Minimum subscription amount determined by REIT offer documents. Must not be a related party.
NBFC is appearing here as a strategic investor actually. Earlier somebody asked whether REIT can be invested by the NBFC. Here it is appearing as a strategic investor. Yeah.
They must not be a related party of the sponsor, manager, trustee. And they're required to comply with pricing, lock-in, and disclosure requirements in line with SEBI norms. They act as an anchor investor to provide confidence to the market. They enhance the credibility, subscription, momentum, price stability during listing, and they attract more institutional participation. They also strengthen the governance requirement in the structure due to regulated, since they would usually be regulated, reputable investors that are investing in the.
So just a small addition here, if you see, this eligible strategic investor list has been further expanded to make it equivalent to a QIB as defined under the ICDR rules. So now you have family houses, you have PF, you have a larger list, which kind of is done to give comfort to the smaller investors that as in when they have anchor investors who are, in a large number, it kind of gives comfort to them.
Now coming to the actual listing of units, issue and allotment. So starting from the draft of a document, it's done through a merchant banker who files the draft of a document with a stock exchange, and within not less than 30 days, the final offer document is filed. It must be open for public for comments for at least 21 days on the website of the board, exchanges, and merchant bankers. The board must communicate comments and require modifications in the draft offer document if required. Now, the offer window, the initial or follow-on offer of the rights issue must be within not more than 1 year from the date of board's observations. Otherwise, a fresh draft of a document must be filed unless it's a fast-track right issue. Subscription, the minimum subscription amount from any investor must fall within the range of 10,000 to 15,000. It can be open for 30 days, and units are issued only in demat form. Then also the REIT, if it fails to collect subscription, at least 90% of the subscription, then the fresh issue and all the money collected must be refunded to the applicants. The REIT must allot units or refund the application money as required within 12 working days from the issue closing date. Any kind of delay, then they must pay an interest 15% per annum to the unit holders. If the initial offer is not made within 3 years from the date of registration, the REIT must surrender its certificate and cease operations. So every REIT unit that is issued must be listed within 3 years from its issue. They can opt for 1 year extension if SEBI allows. The offer document will contain material to correct adequate information and disclosures, just like a prospectus.
One minute, there is
the
a
offer
question.
document.
1 minute, there is a question. Does it mean that maximum investment by an investor shall not be more than 15,000?
No, there's no limit. You can, buy any number of units. So it's up to an investor.
Yeah.
So when you do IPO, the minimum ticket size is 10 to 15,000. That's what is.
There is a minimum, not maximum.
No maximum. Correct. You're
Yeah.
right, actually. It's only a minimum is there. What is the units you can invest? Maximum, it is your choice.
Okay, we can take other question also. Can REIT invest in assets outside India?
No. So as of now, it's not permitted. REITs are confined to India.
And is there a minimum rate of rental requirements to be collected from tenants by REIT regulatory wise?
No, it's market rental. Of course, regulation can't prescribe the rentals to be collected.
Right. Thanks. Kinjal, go ahead.
So when it comes to offer document, there are prohibitions in terms of misleading information, untrue statements, etc. Advertisements also must contain risk factors with print size, everything. So this is similar to how say shares are listed on similar footing as such.
There is another question has come actually. Can a REIT in GIFT City invest in property abroad?
See, I would not be able to answer that because GIFT City, first, as of now, there's no REIT which is in a GIFT City. And probably, if it's set up, it would be governed by the regulations which govern a GIFT City. So, probably it's something which is arising as a restriction there under. But currently, a REIT in India cannot invest abroad. So, I would principally say it cannot, but if there's a specific exemption under the GIFT City regulations, I would not be aware of.
Yeah, GIFT will be governed by that, as you rightly mentioned, their regulations, and it is considered that investment outside India. So it is separate altogether point. What at present we are discussing REIT in India. So as you rightly mentioned, it will govern by the regulation of GIFT City. Yeah.
That is one thing. Second thing is there as on today in the gift city there is no REIT actually today. That is also there. So as he rightly said, once something like that it happened, then it will govern its own regulation which is applicable to the gift city. What about SEZ?
So you can have investment of a REIT in SEZ assets. That's something which is already happening. So if you look at, I think so, Mindspace, they have some SEZ assets in Hyderabad, and I think so similarly at other places. So investment by way of investment in SEZ as a asset which is rent yielding is obviously permitted.
Like I said, all REITs units must be listed, but there are certain scenarios where delisting may happen. So if the public holding or the public float falls below the specified limit, and if the REIT is not able to correct it within the required time period, then it must delist. Then, if SEBI or the designated stock exchange requires delisting for any kind of violation within the listing agreement or regulations, etc., then they may ask to have the REITs delist. Also, if the sponsor or trustee requests delisting and this request has been approved by unit holders, then the REIT collectively by its own can delist itself. The procedures for delisting must include provision for an exit option to unit holders. Also, after delisting, the REIT shall surrender its certificate of registration to SEBI and shall no longer undertake the activity of REIT though liability for any kind of past actions will continue even after delisting. There's some investment conditions and distribution policy requirement by SEBI. So every REIT is mandatorily required to have a distribution policy in terms of how they are distributing their collections and their income to its unit holders. Now, the 80% of the value of REIT assets shall be invested in completed and income generating properties. As mentioned earlier, this is one of the more important requirements of the regulations. Investments must be made only in holdco and SPV or properties or securities or TDR in India in accordance with REIT's disclosed investment strategy, which is mandatorily required to have by the REIT. And it can't invest in any other REIT units of any other REITs. Also, a REIT will not invest in vacant land or agricultural land or mortgages other than mortgage-backed securities. But this exclusion does not apply to land that is contiguous and an extension of an existing staged projects.
So just a point here. So see, the important thing here is the intent is that there is maximum distribution for which this 80% condition has been put in, because unless there is a restriction as to ensuring that minimum size of assets is rent yielding, this assurance with respect to continuous distributions and steady income cannot be maintained. So that's an essential condition. But at the same time, you are permitted within that 80% to look at certain things which are, say, by way of necessary part of the rent yielding asset. So if there is a hotel which is part of the larger compound and you want to invest, and you are forced kind of, wherein the seller says that unless you buy the mall along with the hotel or the mall along with the office space, so basically mall and office is either way that it's a rent yielding, but I'm saying hotel as an exemption, which is kind of part and parcel of it, can be done.
Some more question has come. How Nexus REIT is different from others?
It is free to you. You can answer, otherwise skip.
No, so I can very well take that. So see, the only difference largely is, if you see all the other REITs, they're generally investing in office or IT parks. Now, the difference which Nexus brings into play is it invests in retail assets. So all the investments, if you see, they are largely into shopping malls, which is a retail asset. So that's the difference, and that's kind of reflects the difference in yields, which is comparatively, I'm saying some minor differences. That's by virtue of this difference.
Another question has come. REIT and InvIT, I think infrastructure investment trust is referring, are the similar in nature and have the similar structure, rules and regulations. What can be the reason for carving out a REIT separate from InvIT structure?
So if you globally look at it, it comes under a single regulation, which so across the world, if you look at, there is no difference. They are looked at singly. But in India, SEBI, in its own wisdom, has decided that these are two separate class of assets, wherein one is real estate investment trust, and second is infrastructure, which is for which you can refer to the RBI circular of 2013, which lists down what constitutes infra. So it could be like grid lines or transmission lines, or could be something which is roads, as you rightly said. So they have differentiated, and I think so. The difference largely would be because when you get these assets, they have an end period. So if you look at, if you get a concession for a road, it would be for 10 years, 15 years. Whereas when you look at real estate, it generally comes with ownership rights or a perpetual kind of a lease. So probably the reason, see, I can't be exact what was the mindset behind the regulator deciding to do so, but probably the difference is largely on account of the period that the real estate carries and the infrastructure asset carries. That could be the reason that they're divided into two parts.
Okay, go ahead, Kinjal.
So we spoke about the 80% of its investment that must be in completed income generating assets. But if we look at the rest of the 20%, then it can be invested in other things that are kind of specified by SEBI. This could be under construction properties, which must be held for not less than 3 years after completion. Completed and non-rent generating properties. There may be cases where they are completed but they've still not started generating rent yet, which must be held for not less than 3 years from the date of purchase. Listed or unlisted debt of companies or body corporates in the real estate sector, excluding the debt of the holding company or SPVs. Equity shares of listed companies deriving not less than 75% of their operating income from real estate activity. Also, unlisted equity shares of company holding common infrastructure assets. All these common infrastructure assets, we're looking at several infrastructure assets that are that the company is into. Unlisted equity shares of company providing property management services and exclusively providing services to REIT, Holdco, and SPV. It can also invest in government securities, TDR, unutilized FSI, or any other money market instruments.
Just a small point there. So this is basically kind of a transitionary measure that you may have cash which can't be invested immediately. So they have created these avenues to hold up to 20%, which can be invested in growth of the REIT.
Now, there are certain requirements for the revenue generation, holding period, and lending for the company, for a REIT. So, not less than 51% of the consolidated revenue of the REIT, Holdco, and the SPV, the entire structure, excluding disposable gains, must be derived from rental, leasing, and letting real estate assets or incidental income. So, more than 51%, sorry, at least 51% of the consolidated revenue of the entire REIT must come from real estate, essentially. The completed and rent generating properties must be held for at least 3 years from the date of purchase. Any sale of property, shares, or interest in the SPV exceeding 10% of the value of REIT assets in a financial year requires approval from the unit holders. Also, a REIT shall not undertake lending to any person other than the holding company special purpose vehicle in which the REIT has invested. So it can't go on taking on the role of a lending entity either. As mentioned before, not less than 90% of the net distributable cash flow of the SPV shall be distributed to the REIT and the holding company. Like I said before, holding company will pass on 100% of the same to the REIT and not less than 90% of its own additional income if it is earning by any chance. Distributions must be declared and made not less than once every 6 months in every financial year and shall be made within 2 working days of the declaration and 5 working days from the record date. If distributions are delayed, then the manager is liable to pay interest of 15% per annum on such distributions. If a property is sold and the REIT proposes not to reinvest the sales proceeds into another property within 1 year, it must distribute not less than 90% of these sale proceeds to the unit holders. Coming to related party transactions, as we had concerns when it came to related party transactions of sponsors and its related entities. For purchasing or selling of properties, two valuation reports will be obtained for if this is a related party transactions from different valuers that must be independent of each other. Also, the purchase price cannot be greater than 100% of the average of the two independent valuations, and the sale price cannot be less than 90% of the average of the two independent valuations. Approval from unit holder is mandatory prior to entering into related party transactions. If the total value of related party transaction is more than 10% of the value of the REIT assets in a financial year, or if the funds borrowed from related party transaction exceeds 10% of the total consolidated borrowings of the REIT and the entire structure of REIT essentially. If there is leasing happening to related parties that is exceeding 20% of the total area, asset value, or rental income of the underlying assets, a fairness opinion from an independent valuer must be obtained, and a unit holder approval is required.
Just a small addition here. See, the structuring of REIT is also keeping into mind to give an exit to sponsors. So REITs are very much a part and parcel of, a sponsor and this RPTs. So the assets of the sponsor being bought in as a part of the REIT is very much part and parcel of the entire setup of REITs. But at the same time, SEBI ensures that there's a proper valuation, and in case the acquisition is being done beyond this 10% margin up and down, they ensure that so in case of related party transactions, one, it cannot be done. Second, even when this is done, approval of unit holders is taken.
Looking into borrowing and deferred payments requirements as per SEBI, now even the borrowings of a REIT is regulated. The aggregate consolidated borrowings and deferred payments of the REIT, Holdco, and SPV, the entire structure, net of cash and cash equivalent, cannot exceed 49% of its entire value of REIT's assets. So they must have a leverage ratio that is less than 49%. If aggregate consolidated borrowing exceeds 25% of the value of REIT assets, then any further borrowing, a credit rating must be obtained from a credit rating agency, and an approval of unit holders is required. If the leverage limit of 49% or 25% is breached due to market movements, asset price movements, then the manager has to inform the trustee and rectify the breach within 6 months. A listed REIT may issue debt securities, which must also be listed on recognized stock exchange. So a REIT is not allowed to borrow from a bank, and so it goes on to issue debt securities when it is looking to raise debt for its investments. Now, all the assets of the REIT are required to undergo valuation on a regular basis. So, the SEBI kind of provides regulations for this aspect of the REIT also. So, a valuer who is appointed must be independent of sponsor, manager, trustee with at least 5 years of experience in real estate, and it cannot value the same property for more than 4 consecutive years. So there are different types of valuations. You have annual valuation, which happens 31st March. The report is prepared within 3 months. Half yearly valuation by 30th September, which covers key changes. And then before any unit is issued, a full valuation is taken place, uh, which is like a full-fledged entire valuation of all the assets that are coming under that REIT. The manager must also submit valuation reports to designated stock exchanges within 15 days of receiving them. Also, for any transactions, there's a valuation requirements. Full valuations required for all non-related party transactions. Unit holder approval is required if the purchase price is more than 110% of assessed value as per the valuation report, or if the sale price is less than 90% of the assessed value. If there is any material development affecting valuation, then a valuation must be undertaken again, and the results must be disclosed within 15 days. So in the REIT, it is required that at least unit holders must hold a meeting once a year at least, within 120 days of the financial year end, and gap between two meetings shouldn't be more than 15 months, and manager handles all meeting activities, and trustee oversees that all of this is done correctly. Looking into disclosure and reporting requirements, so the manager must ensure that the disclosures in the offer document are compliant. The manager also submits an annual report to all unit holders within 3 months from the end of the financial year. This report will include all mandatory disclosures required by SEBI. The manager will also submit a half-yearly report to all unit holders within 45 days from the end of the year. This report also requires disclosures as per SEBI. As mentioned earlier, valuation reports are also undertaken by valuation is also undertaken by the company, which is sent out to unit holders. Certain disclosures need to be made to stock exchanges also when it comes to material information. The manager must disclose that to the designated stock exchange any information having bearing on the operation or performance of the REIT, as well as any price sensitive information, which could be acquisition, disposal of properties that are more than 5% of total REITs asset, additional borrowing more than 5% of total REITs assets during the year, any credit rating changes that have taken place, any non-compliance with regulations that are material in nature, and breach of limits. Any issue requiring unit holder approval must be disclosed to the stock exchange on regular basis. Now, even though the REITs units are listed, LODR is not completely applicable to all of these REITs units. It's applicable to the extent of 26A and 26B. Now, Regulation 26A specifies certain LODR provisions that are applicable. These are related to disclosures for debt-related entities, etc. But 26B provides governance norms that are separate and specifically for REITs in India. It kind of defines board composition, where the board must have minimum 6 directors with at least one woman independent director. 1/3 of the total strength or 3 directors should be the quorum, which has one independent director. Video conferencing is allowed, and the quorum requirements for that. And the board must review quarterly compliance reports when covering all laws applicable to REIT, any action taken. Then there's a requirement for minimum information that must be placed before board. These are operating plans, capital budgets, financial results, minutes of different committees, senior officer recruitment, remuneration, show cause, any kind of demand notices, penalties, any kind of defaults when it comes to repayments of loans, interest, etc. Any kind of significant legal cases, judgments, labor issues, etc., must be put in front of the board of the of the manager.
There is one question
Uh,
has come actually. Before listing REIT, should give material development between the date of the listing and the date of the previous financial in offer document. What are those material developments? Any regulatory reference?
So, it could be anything. So, in between, if you have done an acquisition, or there's an addition to assets, or in any of the assets, if there's a material development by way of, any change in KMPs or otherwise. So, this is, I think so, anything which is material in nature, which affects the potential of the SPV or the trust to earn, or affects the assets at large. So it could be that a title issue crops up. So it's a material development which needs to be disclosed.
It is like any other IPO also. There is a material development which is affecting the interest of the company's earning capacity and other things, etc. Here also, which will be prejudicial to the interest of the investor,
Right.
affecting the revenue, stability, liquidity, etc. That has to be actually disclosed. That is the thing, because material development as such, I don't think regulatory is set. In fact, the company has to form its own judgment in having the what is material, what is not material, they'll have to do. That is what it is there. Even in the other regulation, LODR regulator also, it is like that one. Yeah.
Definitely. Go ahead.
Right. So Regulation 26C, 26D, 26E, which are more corporate governance related sections, specifies vigil mechanism, whistleblower policy required for the REITs, where they must mandatorily have that for directors, employees to report any concerns. It should have safeguards against victimization, provide direct access to chairperson of audit committee, may appoint independent service provider that reports directly to audit committee. Similar on the lines of LODR. Then you have secretarial compliance report. Annual secretarial compliance report must be issued by a practicing company secretary, filed with stock exchanges within 60 days of financial year end, and must be attached to the REIT annual report. You have your quarterly compliance report on governance, which is in a board specified format. It's filed with stock exchange within 21 days of quarter end and signed by CEO or compliance officer. Now, even though these REIT regulations were introduced in 2014, over the years, things have changed quite a bit to keeping up with the requirements of the day. So we'll just quickly run through the recent key amendments that have taken place. One of the major ones was, as mentioned earlier, REITs units were previously classified as hybrid units, which are now classified as equity units, which essentially means that for any kind of institutional investors, such as a mutual fund, who allocate their investments into different assets, so a certain allocation is made towards equity units, certain to hybrid units, and certain to other units. And they have certain threshold requirements for that. Now, since REITs is classified as an equity unit, mutual fund investments that are allocated to equity units will flow into REITs units. This is usually a larger chunk of the mutual fund investment. So it is expected that this will increase the liquidity in the REITs market for all investors, and actually increase the fund flow into the industry.
Kinjal, just to add
now
here.
this kind of
Kinjal, 1 minute, I think our panelist wants to add something. Yeah.
Just to add here, see, all these mutual funds, they basically have various kinds of funds, which are equity based, basically security based, in the sense it could be equity, it could be government bonds, or it could be secured, high yielding, etc. So they have caps on how much they can invest in the nature of instruments. So now with classification of REITs as equity, there is a uh, expectation that the amount that can go towards or which can be subscribed by mutual funds will go up drastically. So you can expect
Yeah.
mutual funds to be kind of investing heavily, and so would the confidence with respect to REITs, institutions was vis-a-vis instruments versus individual investors will increase drastically. Yeah.
Yeah. Also, it will be included in the equity indices, which provides market visibility and liquidity, and uh, ensuring that more funds move into this particular instrument.
So as of now, there is no
It
clarity on the subject, Kinjal. So when this will be
Okay.
included in the indices, but I think so the REITs associations, they are reaching out to the SEBI as well as NSE and BSE to see that they can be included, because by virtue of them being included in indexes, there is a portfolio which directly starts getting invested there as well.
Yeah. Right. Then SEBI also, as mentioned earlier, widened the definition of strategic investor, so now they include some qualified institutional buyers, public financial institutions, PFRDA registered pension funds, NBFCs, family trusts, and other large institutional investors. This will allow for more capital inflow from diverse long-term institutions, better stability and scale for REITs, essentially, and easier fundraising for REITs, possibly at a lower cost of capital. Then there were certain governance enhancements undertaken by SEBI. Um, so, it SEBI, mandated that if there are any independent director vacancies, they must be filled within 3 months. This is a relatively faster replacement of independent directors to ensure there's no lapses when there is a vacancy. Then trust duties were standard, so it kind of expanded and codified trustee duties. And it sets out trustee responsibilities for due diligence, transparency, unit holder protection. And external consultants may be appointed for up to 18 months to help trustees adapt under this amendment. Um, Now, they also included a new definition of common infrastructure for water treatment power plants, where REITs can invest in these and can even sell surplus output like power back to the grid under certain conditions. So uh, this allows the ability to monetize common infrastructure and offers new revenue streams for the REITs who have these common infrastructure essentially as a part of the assets that they are holding.
So just to add, Kinjal, this common infrastructure, they are permitted as a facility because there was some confusion whether REITs can hold common infrastructure, which is, as you said, power plants and water treatment and other things. Now there was confusion whether they can be held as a part of the REITs at all or not. So they came up with a clarification, they can be held, but they have put very specific condition that it has to be exclusively used for the purpose of the REIT or SPV or holdco. And if there's any surplus, it has to be necessarily sold to the grid. You can't sell it outside. So the benefit here is by virtue of you saving on the cost of power, but at the same time you can't sell outside. And if you see grid, the price that they pay is very minimal. So so basically, if you see REIT and SEBI has been very clear that we don't want REITs to get into other areas. They should be specifically focused on rent yielding assets, and this focus shouldn't be lost by investing at other places, because they want to give an assurance to investors that, when we have set up a REIT, it is exclusively set up for that purpose and it doesn't start investing in other assets, or it doesn't get into speculative kind of transactions.
Right. Right. Moving on to cash flow and distribution flexibility. SEBI refined what qualifies as liquid assets. Only certain mutual funds with low risks are now allowed. Okay, so this amendment essentially kind of is to allow kind of more funds to flow into the REITs units market and allow for liquidity in the market. Negative cash flow to at the holding company level can now be offset against cash inflows from SPVs subject to disclosures. So before REIT structure required that cash flow from SPVs must be passed on largely without much offset. SEBI now allows holding companies to offset negative net distributable cash flow against cash flows from underlying SPVs subject to disclosure to unit holders. This essentially provides financial flexibility, especially when holding companies may have operational or financing losses, but the underlying SPV is generating profitable cash flows. So this is just kind of an offset that is now allowed. Then the lock-in and flow-on offer, follow-on offer rules. So for preferential issues, 15% of units allotted to sponsor groups must be locked in for 3 years. Remaining sponsor allotments can have a 1-year lock-in. Inter-se transfer of locked-in units within the same sponsor group is now permitted, but transferees can't transfer further until lock-in expires. Follow-on public offers. SEBI has laid out clearer framework requirements for in-principle approval, primary exchange, and dematerialization issues. So these amendments, essentially, they have a lot of context and lot of background to it, but given the paucity of time, we will be quickly just running through it. Before, sponsor units had to be locked in, but there was less clarity around inter-sponsor transfers and follow-on offers and their terms. But these revised lock-in of 15% and inter-sponsor transfer and all kind of clarifies this ambiguity which was there in the market. Moving on, valuation reports must now be submitted to the trustee on the same day as filing to the stock exchange. Timelines for annual and half-yearly valuation reports are aligned with quarterly financial disclosures. So before valuation report, quarterly financials and other disclosures didn't have aligned timelines. And now this alignment of timelines improves transparency, reduces lags, and makes relevant information more timely for investors. Unit holders get more up-to-date data and help in better decision making and risk assessment, essentially. I think we have pretty much covered what we had to for today on the topic.
Thanks a lot, Kinjal. You have done a wonderful job, actually, because this being a new subject, it is quite a vast subject. You have put everything more or less in the capsule form, I must say. My appreciation to you, actually. So we move on to the question. I think there is one more question which is appearing there. Can REIT, what is the basic difference between the REIT and InvIT? I think our panelists already explained. It is actually basically the underlying assets, because REIT is actually having underlying assets of the income generating real estate, whereas the InvIT is actually on the investment of the operational infrastructure projects. I don't think other than that any other difference is there. That's what he said. He also touched upon in other places the regulations the same in India, but somehow other in their own wisdom, our regulator has actually made in the two regulations. That's what he actually said here. Is it the case of the Nexus that he already answered? I think
the question is that can REIT generate income from subleasing? taking lease from others and subleasing them. Is this the case of
Okay.
Nexus?
So,
Okay.
if you look at REIT regulations, they permit you to hold the asset on freehold as well as lease basis. So when you look at perpetual leases or leases which are granted by, say, MIDC, the closest to our place itself. So MIDC Sitco. So if you look at Sitco, they are granted itself for 60 years lease. Of course, there's a provision for renewal. So when you're looking at real estate, you have to look at those as well. So when Mindspace or we, or for that matter, Embassy, invest in MIDC land in Pune, Bombay, and set up an office park or a shopping mall, they will obviously have assets held on lease basis, which are further subleased. So, it's like coming from that basis. So generally the principle is nobody gets into, doing say like 10 years lease and then further subleasing. That's not the intent. The intent of the REITs is that you have a long-term lease or ownership basis, which are used to create rent yielding assets and thereafter leased out.
There are a lot of people are appreciating it, saying very good, very information, nicely covered. Thanks to the valuation presentation. And Kinjal Shivaraman is actually saying kudos to the presenter. Excellent job. God bless her with more and more achievements. That's what he is actually wishing you. There are other people who are also appreciating you very much. Can you please explain the requirement of the REIT for this product? Like applicability will be treated for of equity or mutual funds?
PITR for this product. Can you explain the requirements under PITR for this product?
PIT is fully applicable the same way as equity. If we are talking about prohibition of insider trading regulations, that's fully applicable in the same manner. So you have trading window, you have periods wherein which you can trade, which you cannot trade, and you can have a trading plan. All of it applies as it is to REIT units as well.
Any security which are actually traded in the stock exchange, then this regulation will be applicable like any other regulation. That is the requirement. Any securities.
All questions are over. If anyone wants to speak, please raise the hands. We will give it, or we will close this.
Yeah, we will see anybody has risen the hand. I don't see any hands are risen.
Yeah.
Anyway, we can invite.
Yeah. Friends, lot of appreciation for the topic. So thanks a lot, Mr. Khemchand. We were knowing this REIT is a new topic. It is growing, and that's why we wanted what is the scope of CA and CS here. How many PCAs can think that there is a compliance report or report company secretary has to also to give report, which will be attached to their annual report. And that's why this session, that friends and colleagues, there are a lot of opportunity of compliance, governance and certification in REIT as well. And of course, for a chartered accountant, lawyers, of course, there is a lot of opportunity. Thanks a lot for your participation and active participation, friends. This was new topic, and still all of you questioned a lot. And panelist was literally asked to so many things from different view, from accounting, as I mentioned, many chartered accountant attended this. So taxation angle also comes into our question answer sessions. Thanks, Mr. Vijay. You have attended all the questions in a very lucid manner. And everyone gained, you can see from the appreciation. Thanks. It is thanks to you who share the knowledge with us and the audience. That helps everyone.
Yeah, I really have to appreciate the way Kinjal ran it. In fact, I was telling her yesterday, this is as good as a masterclass. So he has virtually covered everything, in respect of the REIT regulation. So kudos to her. And kudos to Mehta and Mehta to having organized this, and to you, ma'am, and Mr. Bala.
Thank you. Thank you. We were wanted that in a, kind of a series of sessions, but REIT are yet started. So we wanted all the professionals to develop the interest. Then we'll surely have a session and we'll ask you. Thank you.
It's a very good. It is being a new topic. Definitely, there's a very good opportunities for the practicing people, as Dipti pointed out. Really, we'll have to get familiarized with this so that we can echo, because it is not going to stop here, because it is only the beginning. it is definitely going to enlarge development much take place. It will go in a larger way. That's what I would think actually. Really speaking.
Just to add at the end, just a small point. So
Yeah.
if you look at the company secretaries, they are playing a very big role in compliance because this is very focused to secretarial. And unlike certain listed companies which have a lot of focus on listing, this clearly is a very focused job considering vis-a-vis secretarial. And there's a lot of certification and opinions which we keep approaching practicing CS. So I would specifically like to bring out that this is some area which probably people have not taken as actively as they, or practicing CS have not taken it actively. They should take it up. There's a lot for them to do, and in fact support corporates in ensuring that they are necessarily compliant.
Thank you, Mr. Vijay. Thanks, and we'll invite you again for your knowledge sharing.
My pleasure, ma'am.
Thank you, Mr. Bala. Thanks, everyone. Thanks all. Thanks, Kinjal. Very good presentation. Thank you, everyone.
Thanks a lot to everybody. Wish you a good weekend. We meet yet another session the next week. Thank you.
Thank you.